Welcome to the Motor Carriers Insurance Education Foundation in-depth review of coverage addressing the unique operation of a motor carrier webinars. This session is going to be cargo coverage consideration for interstate for-hire motor carrier. Again, these webinars are not filed for state CE and is a learning opportunity only. If you have any questions or you want to seek CE, you can contact our office at trs@mcief.org and we'll provide you the information or answer any of your questions. So let's look at the cargo considerations for insuring interstate for-hire motor carriers. You've got to remember, these are the customer's cargo. Claim handling affects on customer's relationship with your insured, the motor carrier. So the claim handling is the most important from the insured's viewpoint, because if not properly handled, the motor carrier's relationship with their customer can be interrupted and therefore they lose the customer. It's also the most important from a retail agent standpoint, because this is the one coverage that you could have be called upon to respond and the cargo policy might not, which could expose you to an E&O exposure. It's also most concern for the shipper or broker. They will not do business with the motor carrier who do not have an acceptable insurance company. So the customers that are not satisfied with the cargo insurance would be a problem with your motor carrier. So considerations when agent decides on a policy to present: claim handling reputation of the company, accepted by the insured customers. Insurance customers, brokers know of companies who traditionally don't pay claims. You do not want to sell a policy that you have not reviewed and then going over with the insured, highlighting, explaining any limitations of coverage. This is a key part here. So factor in when you choose what company to write. Though they have solid claim handling, will your insured's customers accept it? And have you read the policy, review the policy, understand what the policy does or does not do, and then review the insured's operations to see if there's any areas that might not be covered, and if they are, to tell the insured about areas that might not be covered. So providing transportation property of others, for-hire trucker, it is their business. If property is damaged while being hauled, they would be held responsible to protect the other property being transported. This is a bailee responsibility. A bailee is someone with other people's property. They do something with it. You're familiar with it if the service people work on your garage. That's garage keeper. Could be familiar with it with laundry and dry cleaner. In all those cases, these companies do something with other people's property and are expected to return that property in the same condition or better than what they received it. If not, they could be liable. So the for-hire motor carrier is a bailee, must take care of the property they're hauling. If not, they could be liable for the damage. Because liability is insured buys a cargo policy to provide the bailee coverage. And the reason they have to do that is because of the care, custom, control exclusions in the auto and general liability policy. So since the auto and general liability policy exclude payment for damage to property in your insurance care, custom, control, therefore they must buy a cargo policy to cover that exposure when legally liable as a bailee. So the bailee forms are unique forms. They address liability. When will the insurer, and they'll respond when the insured is liable. But they also have property principles. It must be caused by covered cause of loss, and it must be covered property, meaning not excluded. So therefore, it's a combination. It's a hybrid policy where you have two triggering of coverage. The first trigger is it will respond when the insured is legally liable. That is the bailee responsibility. That's the liability responsibility. But it will only pay if the damage to the property is caused by a covered cause of loss, and that the property that is damaged is not excluded. And so those are the two elements of the bailee policy. So it addresses the liability first. Let's talk about that. Carrier as a bailee must take care of the other's property under common statutory contract law. The common law, negligence, basis of carrier property. That's the prudent person rule. Shipper protects in that rule, and the shipper protects their own self by asking the motor carrier for this cargo coverage by the motor carrier. This is how the shipper says, okay, I'll give you your cargo, but I want to make sure while you have it, if something happens to it, that it's going to be insured by you, not me. And so this is where the burden of covering it is pushed back onto the insured. But there's another element. Again, the focus of the foundation is for hire interstate motor carriers. And there is a federal law called the Carmack Amendment that addresses interstate shipment. And these are subject to Carmack. So not only the care, custody, control, the prudent person rule, the common law rule, and transportation and for hire motor carriers, you have the additional element of the Carmack Amendment. So what is the Carmack Amendment? The Carmack Amendment is a law applied to motor carriers by Congress in 1935. ICC started in 1932. This was added shortly thereafter. It spells out the rights and duties and liabilities of shippers and carriers when it comes to cargo losses. Who does the Carmack Amendment apply to? The Carmack Amendment applies to shippers and motor carriers involved with interstate shipment of all consumer commodities that are not exempt. And the exempt, again, is saying the same thing, who needs the DOT number and additional MC number. In the regulation standpoint, these are people that are hauling the agriculture goods, fishery goods, these kind of non-processed goods. So it applies to anybody that has the MC number hauling processed goods of others in interstate commerce. Who is liable for the cargo damage under the Carmack Amendment? The Carmack Amendment holds the carrier liable for damage to the goods if transported without proof of negligence, with 5 exceptions. So you're absolutely liable. And that means if something happens to it, even though your insured did not cause it, let's say your insured truck is sitting at a stoplight and somebody runs into it, causing the cargo to burn up, your insured is not negligent. If it was an auto liability case, we would have no response to it for paying injuries to the car that ran into us. But in cargo, the Carmack Amendment requires the insured to be absolutely liable for it, the cargo policy to respond to pay it, even though the insured did not cause the damage. This is absolute liability with only 5 exceptions. First off, acts of God, hurricane, winds, those kind of things that could turn it over. Public enemy, that's involved in war. Acts of the fault of the shipper. I'm going to get back to this in a minute. Public authority, that's a quarantine like a hurricane, where at one point with Charlie, we could not get to Fort Myers Beach, or inherent vice of goods. And so those are the reasons out. You have to point those 5 out to, or the insured's absolutely liable except for those 5. So the only 2 that also relevant. What are the shipper's responsibility under the Carmack Amendment? To hold a motor carrier liable for cargo damage, the shipper must prove that the goods were in good condition when given by the shipper. The goods were damaged when delivered or were not delivered, meaning that the quantity was not delivered as promised, and the amount of damage. So that's the shipper's responsibility, or the consignee who receives it. How much damage a carrier is liable for? The Carmack Amendment limits motor carrier liability to the actual loss of the injured property. The big part of this is a big savior for our insured, because it does not make them responsible for loss of use. Because if it's a just on time delivery and the factory or the sales are lost at the retail level because of problem that was there, we'll replace the cargo policy. The Carmack will make the insured replace the item but not pay for loss of revenue generated because the item wasn't delivered on time. Is there a way a motor carrier can limit their liability for in the Carmack? Yes, that's the release bill of lading. When you hear the release bill of lading, it caps the amount of dollar responsibility the motor carrier has over a set amount. Other than this, they would be absolutely liable for a full dollar. These are found in mainly 2 big industries, the moving and storage industry, because household goods, what's a couch worth? It has nothing to do with weight, it has nothing to do with a couch. It's all over the board. So that has a federal law that limits it to $1.25 a pound per item. And a lot of times, again, same thing with intermodal, where you have sealed containers on ships where the insured does not is not able to, the motor carrier is not able to see what's there, that will be limited typically to $300,000. So this is where you can limit the liability based on a fixed amount by agreement of the two parties. How can a motor carrier respond to cargo claims? They can either deny or pay, or cite one of the 5 outs. Again, we'll drill down on those in a minute. What are the Carmack Amendment for filing the claims in a lawsuit? This is the shipper. The carrier are permitted to limit the time shipper can file claims to 9 months from date of delivery, and the timeline for filing a lawsuit can be limited to 2 years and a day from the day of which the claim is denied. So this is just like the statute of limitations you hear. If the claim is not filed once the goods are there in 9 months, then they're stopped from filing it later. And once the claim has been denied, they have to bring lawsuits within 2 years and a day. But the caveat of all this and walk away is this stuff can be changed by the agreement that the insured signs, either with the ongoing contract, if they're a contract hauler, or the bill of lading, or the contract of carriage, or in the shipment receipts for the individual loads if it's hauled on a spot market or a broker situation. So let's talk about a couple things here. Verification of what's being hauled. Again, the shipper has to verify what's being hauled. When the truck pulls up to loading dock, a lot of situations with the drop and hook situations, the driver is not even allowed to be on the premises. They cannot see who's being loaded. The shipper does the load. And a lot of times the power unit actually detached from the trailer. And so what the driver is given is a trailer that's already loaded and it's already sealed. And so the concern here is if it's already sealed, the driver did not see what was there. And so the driver needs to make enough notation on the receipt. Customer load and count, CLC, meaning I did not verify what was loaded. The customer loaded it. It was sealed. I had nothing to do with it. I'm not verifying that I'm picking up a certain amount of cargo and a certain condition. All I'm verifying is I'm picking up a sealed trailer. And here's the seal number. And then the driver at the other end, at the consignee, must find someone to sign to say, I received it, still sealed with a seal number. This is how you prevent the problem here. The driver doesn't do that, and there's the load that gets delivered, if the content is not in the condition expected, or not enough content that was supposed to be shipped and the seal's still there, then the customer is going to say, well, the driver received it, so therefore they should have verified it. No. Now, if the driver can verify it, meaning they can stay on the dock, they can count, they can watch it. If it's temperature control, they can check the temperature before it's loaded. Then they do receive it here, but they need to also make sure that they did receive it in good condition. So this is determination if it's a sealed container when they receive it or not, or sealed unit receiving not, and that's the important part here, because this is where it's going to start. What was loaded on the trailer and what condition it was in, and how, and the verification by the shipper that the numbers were delivered and the condition. It's up to the motor carrier to make sure what they received when they can view it is represented by the receipt they sign. Shipper error. This is the thing the shipper could do. This is the real out here, the packaging. If they don't properly package, if it's or stacks it too high or doesn't load it those areas, so the packages can crush. If they give you the wrong destination delivery, or if they don't give you time to deliver it on time. You know, you have all this sell by date on all these food products. If the shipper did not give time to deliver the goods following the hours of service regulation and then you got speeding regulation in timeline before the out of date number is out of date date becomes a factor, then again that shipper error, not giving enough time. And here's the biggest one: the care of the cargo spelled out. Temperature control, what temperature can be kept at. I had a situation where a load got delivered and it was a load of gladiolus bulbs. Now, for you who do not know Fort Myers, we were the gladiolus center of the world. In fact, we have a road called Gladiolus Drive. We have another road called A and B Bub Road. In fact, my father moved to Fort Myers, Florida, and the first reason he moved is haul flowers for the Florida Fire Association before he got involved in hauling the pickles for Vlasic. A gladiolus is an annual, so the bulbs get recycled each year. And after the growing season, the bulbs get harvested. They put in a cooler. They get cleaned up a little bit, sometimes split, so there's multi-blood bulbs. And then at the season, then they get delivered to the farmer to be replanted again to have another season. These bulbs that we're talking about here were coming out of Houston, Texas to Palatka, Florida. Palatka is just a little northwest of Orlando, and that's really the only growing area now in Florida that's growing gladiolus. Most of the stuff around Fort Myers, where I'm from, is now condominiums where we used to have gladiolus fields, which is a lot of difference in how you look at things. The site's not as pretty as it was before. Anyway, it received, and when they got to the delivery point, the bulbs were sprouting. The agent called me up and said, Tommy, I probably already know this answer. I love it when y'all tell me this stuff, but my insurer just delivered a load of gladiolus bulbs, and they were sprouting, and they had trailer breakdown coverage. And they said, do they have coverage? And I said, well, why was the temperature not kept properly? And he said, because the driver never turned on the refrigeration unit. Therefore, the no coverage, the buyback for the mechanical device did not be triggered. So therefore, there was no coverage in the cargo form because it had a spoilage or temperature change exclusion in it. Then I asked the agent, but let's go back. Did the shipper tell the driver what temperature to be kept at? Was it on the bill of lading? Was it on receipt? They went back and it was not. So my comment to the agent was, this is not going to make your insured's relationship with the customer happy. But since the customer did not tell the temperature it's supposed to be kept at, you're not liable for it because that's shipper error. This is the kind of thing that can come in place. Also, limitation coverage, actual loss to the property, not loss of business. This is also one that came up. Our agent called me up. My insured was hauling a large piece of machinery. They ended up damaging that machinery when they ran into a bridge. That's a whole different story. Let's talk about the good of the goods. Because they could not deliver the machinery on time, the person who was receiving it is now suing our insured for the loss of use of that machinery because our insured damaged it. Again, I asked them two major questions. The first one I asked them was it interstate commerce? Answer is yes. And second was there any contract that waived the Carmack Amendment? They came back and said, no, it's a standard bill of lading. So therefore, I'm saying, well, it's subject to Carmack, so therefore your insured is not responsible for the loss of use, the consequential damage because they didn't deliver it on time, just the actual damages. This is how this becomes important, both on the shipper error or what we don't owe. You also can have the release bill of lading. This is where the value is set, and this expels the maximum amount. But without that, without the maximum amount both agreed upon, your insured is responsible for the full amount, no matter what the insured, the customer requires for coverage. The bill of lading is an important document. This is a contract of carriage. It's a receipt given to the carrier by the shipper, and that is signed by the motor carrier. And it should spell out the name the motor carrier is providing transportation, not the broker or another motor carrier, the name the motor carrier who's actually receiving it, where the property was received and from whom, the shipper's name and goods, and also it's not always the shipper, and then the date that's received, description of goods, the number of packages, weights, whatever it is. It could be gallonages, it could be pallets, it could be packages, it could be bushels, whatever it is. And here's the key: the care of the cargo, the temperature it needs to be kept at. You cannot stack it so high. You flatbeds, you need to keep it tarp for weather damages. The care of it. The name of the consignee, the person who's going to receive it. Again, it's not always the buyer, it's the person who receives it, and also the designated routes if they're required. And then should that include is it subject to the insured's tariff? The tariff is a document that the insured develops that says, I'm willing to haul for X dollars, but a part of that tariff should say it's subject to CARMAC. Therefore, when they sign it, the CARMAC amendment would be put in force. And this is then who is paying for the shipment here. This will spell out what's paid and what has to be paid. So this contract of carriage becomes a document not only in the receipt of it to start the movement, but at claim time. This is one of the things that the claims adjuster are going to seek on behalf of the motor carrier to properly handle the claim, and this will show these items here, and this will give the insurance carrier who's handling the claims some discussion about how does CARMAC affect it or not. It was a ship error, are we responsible for everything that they're claiming? And so this contract of carriage becomes an important document, both to make sure that it's valid when the insured signs for it and they're complying with all the agreements, and if something happens, for the claims adjuster to use to start the paying process of what is owed. What is being shipped? Information from the shipper, who are their customers. This is something to underwrite. It's underwriting. What's being shipped? Information from the insured, who are their customers. This is a key part of this. And we can back into this for other reasons, because the primary reason you want to know who your insured customers are, because these customers are requiring proof of coverage, and they're going to require proof of coverage. That would not only be cargo, that could be auto liability, that could be a requirement for general liability, that requirement for work comp. These are requirements that are going to have to be met, and not all are in terms that are insurance industry terms. So one of the things that you need to encourage your insurance to do, and you need to do as a retail agent, ask them, who are your insurance customers? And the way you ask this is to say, look, when I deliver this policy to you, when I provide this policy to you, the first thing you're going to ask me to do once I make your 91X filing, once I meet the federal requirements or the state requirements for me filings, the first thing you're going to ask me to do after that is to send a certificate of insurance to your customers so you can pick up a load. I need to know what those customers, who those customers are, and what those requirements are, because this is a part of underwriting. So I want to make sure I can handle that. But by doing that, you're not only going to be able now to meet that need so they can deal with the customer they want, but now you know who their customers are. So in most cases, you now know what's being shipped. What the underwriting process is percentage of each. They're broken into about 4 or 5 categories, depending where, food goods are the same, whereas cucumbers or pickles. You have machinery is the same. You have motorized vehicles that are same. It's there. You have rubber products the same. It's all those things, and the percentage of each haul. This is a concern because you want to find those out. Now, what you can verify, and this is you who have access to third-party providers, Central Analysis Bureau, and carrier software, what are other means to show what inspection happens. Because when a vehicle is stopped and they are inspected, the officer reporting that inspection will say who the shipper is. You also can look on the site of your insurance and look at their bill of ladings that they're signing to find out who the shippers are. So we can find out from external purposes, besides asking the insured who their shippers are and what's being shipped, but we can verify from the inspection reports that are available to us through a third-party provider, or we can look at the bill of ladings, the retail agents, to find out who the shippers are. You also can look at past claims to see what kind of property was damaged. But it's important to know up front, because cargo policies are going to have exclusions from certain types of cargo, and you want to find out the best possible what cargo insurer is hauling, so that you'll find out, so later that you won't find at claim time there's some limitation or some items that are not covered. You also want to look at auto related. Again, driver. If the driver is prone, the same reason you have auto liability, but even more, because now if the driver causes a crash, even though they might not be liable, we have to respond to it. What's the vehicle condition? Is the Thermo King in working order? Is the trailer sealed? Can the cargo be handled? How many accidents? Again, accident proneness is a concern here of frequency in this case, not only severity, frequency, because now no matter who calls that accident, don't say, well, liability, we might have discussion, well, my insured wasn't liable, it was not preventable, they ran into the animal, they got ran into when they were apart. We can look at those for liability and kind of discount those, but in cargo, we can't discount that because we got to pay anyway. And yes, we can go subrogate back against our whoever hauled it, but you know, $100,000 worth of load. If you're in Florida, the insured has no only required to carry 10,000 property damage, so that would go very far. The reason I put length of haul because the hours of service that after the driver drives so many hours, they must stop and rest for a certain many of hours. And for every one of those cycles, that truck has to be stopped for a significant period of time. And that significant period of time they have to stop. Now that cargo is subject to theft. It's tough to steal a load running down the highway, but when it's stopped because of the required rest period or for fuel or for food, then that's when it's subject to being stolen. As a friend of mine says, who's a major cargo writer, cargo at rest is cargo at risk. So we got to find out how many are being hauled. Also, where it's being hauled. One of the things for high value items, it's hard to maybe dispose of if it has a serial number or has to be activated in the US. So a lot of theft centers around locations where you can export it easily. And that's your ports, where there's water ports around where your insured can steal it and then put it in a container and ship it overseas. So these are things that you have to consider depending on the trying to underwrite the nature of the items that could possibly be could cause later crashes or theft. And then the nature of item: is it perishable? Will it is it time sensitive? Will it spoil during the process? Is it fragile? Will it break? Size: I'm talking about overweight, overload. Is it hard to handle? And if it's theft prone. And this is kind of misunderstanding because when we talk about what's theft prone and big dollars, people think of the big dollars. But the latest statistics you'll find, it's always for the most frequently sold things that are commonly good. At one point in time, it was diapers. It can be canned food. It can be soft drinks. It could be things that have no serial numbers that can be sold. Because you've got to remember, when somebody steals something, they got to get rid of it. So it's things that can be easily sold at a flea market, easily sold at a non-convenience convenience store, easily sold online. In fact, Selective Insurance Company, who I do a lot of work with involving their CE, told me a story one time where they had a load of golf balls stolen, and they were able to track the process of the stolen golf balls to find that that load was sold on eBay a week before it was stolen. This is selling something and then going finding, accessing what you had to sell. So everything can be theft prone. So the insured needs to be cautious to make sure they've done things to prevent it, make sure the driver's screening there, make sure the power unit is not detached from the trailer, to make sure that it's parked in conspicuous places at truck stops with lighting and things like that during their time to be rested or time to be fueled. They just need to be cognizant about it, even though they do not have a high items with a lot of dollars involved in it, they could be easily stolen. They also need to make sure every time they get out of the truck to walk around it to make sure it's still sealed, if it's a sealed load with the seal number on it, and or if it's padlocked, which most of them are, or some other means of security, that security is in place every time they get out of the truck. These are things the driver needs to be aware of because of this theft proneness situation. Method insurance premium is reflected on number of power units. You want to make sure you have the owned and operated, meaning the owner operator is considered here. Coverage while property is in the custody of the insured or reliable for it. Have terminology: care, custody, control, being responsible for it, care, custody, or control. These are kind of things, and involved in the contract your insured signing. So this is where you want to make sure that you have every carrier compartment, every trailer they're going to use covered, and you want to make sure that when they sign an agreement to become responsible for it, even though it might not be on the trailer yet, even though it might not be attached to the tractor yet, that policy will respond. You got to watch the more limited coverage. This is not as prevalent as before, but you'll find some that says we'll cover cargo while in or on any undescribed trailer while attached to a described power unit. My concern here is that there's legitimate reasons for trailers to be detached, mainly because loading and unloading purposes, because the shipper will not allow them to be attached, or for emergency breakdown. And this is what bothers me. And the other side of this is one of the theft bonus is never detach it. So there is some reasons that you want to keep it attached to make sure that the trailer is not subject to theft because of no power unit there. But you want to also be consideration that you don't want to avoid coverage if the shipper requires it to be detached for loading, unloading purposes, and or there's emergency breakdown. So you need to be aware that some more limited policies or some policies might have that requirement in it too. The limit to premium base, that's the maximum payable. But a lot of times that limit is set by the customer's requirements. If the customer requires $100,000 and your insurance is hauling $240,000, which happened in the case that I was involved in, again, because agents tell me about it, your insured is still responsible for the $250,000, even though the customer only requires $100,000. It's not a release bill of lading. The broker, this is particularly involved when a broker where they do not know what's being hauled. Most shippers require a higher limit, but brokers have a standard amount. So you want to make sure to verify that what they're putting in there, the limit that you're having is more or enough to cover the items there. You also have a per unit and per commodity. One of my clients, actually the person who bought my father's pickle business, had a deal out of Central Florida where they were hauling grapefruits up to the port of Charleston. And so they were hauling grapefruits to the port of Charleston, and on the way by they have to go through Jacksonville, and just north of Jacksonville there is a Budweiser brewery on I-95. And so they cut a deal where they would pick up a return load, pick up loads of beer, taking it back to Budweiser and taking them back to people in Polk County and Hillsborough County and South Florida, West Florida. And so we wrote a policy covering their grapefruit going up and $50,000 for their beer. While they're hauling beer, and they reported how many. You'll find this all sometimes if you're dealing with moving and storage where you have different requirements that they're hauling for the military. You also need to worry about per unit per occurrence. This is a concern here because most of the policy says we'll pay per unit, but no more than 2 times for any one occurrence. This is a concern where your insured could have 2 loaded trailers at the same location that could be damaged at the same time. Typically, this will be 3 places: your insured's yard, a staging area before they can get into to unload. Most of the time when you have these big unloading facilities like Amazon and these places, they kind of keep the flow coming in and out. And so a lot of times those trailers are parked in the staging area before they can get into those things, again, parked in more or not. And it could be rarely, but it could be at the same truck stop. You just need to be aware that you have that catastrophic 2 times units here. Property not covered or limited. Item is not in insuring agreement, meaning what the premium is based on. There's possibly no coverage. So you want to balance the list on the deck sheet that might not be covered, and you need to concern these things, and it explains to insured there's just everything you're hauling. You don't want miscellaneous. You want everything they could haul. And then limited or excluded. It could be covered, but you got to remember, everything can be covered. This is a price consideration. And so what you got to tell your insurer, look, we're basing your premium on because you're hauling this type of commodities. If you ever have a chance to haul other than this, then you got to give us a call. We can clearly cover it, but you're not paying us to have it covered. And so you need to make aware of what might be limited or might not be covered in the form and the nature of the cargo that we had here. Had a situation involved here where the insured had a renewal policy. We asked the insured the agent asked the insured what we're going to haul, and they said this, this, and this, and 5% of miscellaneous stuff. Well, that 5% of miscellaneous happened to end up in copper. And guess what the policy excluded? Precious metal and copper. And so when that load of copper got stolen, then there was no coverage for it because of the excluded property. The insurer said, well, that was a part of the miscellaneous. because the quotation clearly said we don't cover copper, and because the agent convinced the judge that they said to you did not copper, that then saved the agent E&O, but I got involved in it from the expert witness standpoint. This is a concern here. And by the way, the copper was stolen in Georgia, but they found the empty trailer at the port of Miami. Again, it got exported here. You must review, again, agent underwriting consideration, what the insured is hauling, and then go over what might be excluded and limitations with insured by commodity. You've got to spell this out for every policy you deliver to make sure that there's not limitations in the policy that will cause problems later when the commodities got stolen or the commodities got damaged. Method to insurance consider. Agent, you got to read the policy before the claim and before the insured does. Real world story. My favorite insured was the local beer distributor, Mark V Distributors. I insured them for a number of years. Actually, I started dealing business with them before I got into the legitimate business selling insurance, because early in my career, I sold trucks. And at that point in time, the most preferred truck for beverage delivery was the International Harvester 1600 with Mickey and Hackney bodies on them. And I dealt with all the software and beer distributors in the area. In fact, it drove my Southern Baptist mother wild that I contributed to 90% of all the beer consumed in Lee County on trucks that I owned or sold because I had a truck leasing company. So once I got into legitimate business and sold the dealership, I called on customers I'd sold trucks. And so Mark V Distributor was my first commercial policy I wrote. I did a great job. Greg let me write the policy. And then about a week after I delivered the policy, Greg called me up and says, "Tommy, did you read the policy you delivered to me?" Well, I'm a type A personality. I don't read anything. What do you say to him? Let's go have a beer. There's plenty already there. I said, "What happened, Greg?" He said, "You delivered me a policy that excluded alcoholic beverages if they got damaged in cargo. What do you think beer is?" So the first commercial policy that was a cargo policy ever delivered did not cover what my insured was hauling. I learned that early. So folks, you've got to read the policies and then review with insured any kind of limitations or things not covered. Hopefully you want to avoid this lesson that I learned early on. Crash scene. This is where the #1 cause of losses are crashes. Theft being a part of the high dollar value, but not the frequency. Cargo must be removed from the crash scene. And the reason it's going to be removed and how we're going to be paid is because of protect and preserve provisions in both the physical damage coverage and in the cargo. And so the first thing you have to do is protect and preserve, meaning that's salvage. Load onto another unit. You might have to now load it, have to store it before you get another unit. This might require refrigeration. Then you want to take care of the salvage, and in some cases, it can be salvaged. We'll talk about that in a minute. Sometimes the customer will not let it be salvaged. Then it has to be destroyed if it cannot be salvaged because it's debris. Then what has to be stored? This would sometimes be the customer officers, or it could be things that are just cannot be recycled, cannot be used, cannot be good anymore. And so therefore you got to worry about where it can be destroyed, because you can't just put a thing in landfills. So at the crash site, we have to worry about what has to be done. Protect it, salvage what you can, which require loading to another unit, moving it, and then find out what can be salvaged or not. If it cannot be salvaged, store it. All this becomes a factor that's going to be cost of handling the cargo. And this comes into the record bill, because the record bill is going to include in cargo not only that cleanup, not only the picking it up, not only restoring it, not only to removing it, that cost. And so now you're going to get a bill. And so the bill is going to be from the record company, from the from the towing company. And the bill is going to include not only the stuff they did for cargo, but also the physical damage. And so the unit is not going to be removed until the bill is paid. So now as an agent, you've got to understand, here's the conflict. And this, again, record bills are the #1 conflict here, because currently they're out of control. Because now you've got to coordinate with the physical damage carrier and the cargo carrier who's going to pay the record bill. My personal opinion, the reason we want to have the cargo removed and getting back out of the wrecker yard is so it can be delivered to the customer. So the first place I want to look at this is for the cargo carrier to step up and pay their wrecker bill, have an agreement with the physical damage carrier later to settle the dispute of who pays what. Because you could have three different concerns to pay wrecker bills. You can have the power unit, who might be insured by company A. You could have the trailer, which might not be insured at all, and you could have the cargo, who's going to be insured by company B. And so now you have three places that you could have to split the bill. It's not fair to split it a third, because a lot of times the cargo requires more of the wrecker company's efforts than the physical damage, just jerking up and towing it. And again, the storage bill has to be paid before the cargo can be released, and that's important, again, to get it out there so the cargo can still be able to be delivered and have some value. You also have to worry about loading and unloading. We're not talking about liability now. We're not talking about the damage done while loading and unloading. We're talking about what we're loading and unloading could be damaged. Again, it's excluded in carrier customer control, and so we have to look at it. Is the driver involved in it? If it's drop and hook, they're probably not. They don't have anything to do other than park a trailer at a yard, and when they park the trailer at the yard, the customer loads or the customer unloads it and gives it to your insurer. No problem. But a lot of times they might do, and this is a particular flatbed operation, where it has to be loaded and unloaded by a mechanical device or by a crane. It could be things like cars, which have to be driven off, or machinery has to be driven off. These things. These are triggered by the coverage form. And so what you've got to look at, some forms say we're going to cover the cargo. This is damage to the items that are being loaded and unloaded, but only to curbside or to dockside. If your insured has anything but drop and hook, you have a problem with that. You want it more than that. If they're auto haulers, you might want 5,000, which is a mile feet away from it. So you got to look at these, and then carrier insurance policies vary about how far they'll cover the damage to the cargo once it's removed from the carrying compartment. And you want to worry about it when it has to be removed by hand devices, or you have to have it removed like cars and things on forklifts away from the unit. And this will be spelled out in the responsibility in the contract. That will be in the bill of lading. So you need to check those things. And other than drop and hook, you need to talk to your insureds about that. Cargo that can be contaminated or salvaged becomes a problem. Again, Food Safety Modernization Act, FEMA. This was effective in April 2017. This talks about human and animal foods. This is where the shipper has the right to reject loads for about any reason. Therefore, there will be no salvage until somebody signs off on it. Pharmaceuticals. If it's sealed, we're worried about, again, things going into the human body, just like food and animal. Have those items been adulterated? Is there a problem with those things there? If it is, then there's no salvage. Warranties are the things that can be damaged later. For example, car seats. You might not think about this, but I came to realize this, and I bring it back in my talk because a number of years ago, my daughter got run into the back of her car with two of my 12 grandchildren in the car, the younger ones, in car seats. There was little damage to the car, less than $1,000, but both car seats had to be destroyed because there was too much risk in that the car seats were damaged, that the liability carrier who paid for the damage to her car said the car seats had to be destroyed before. So what we're pointing out here is that if your insureds are hauling a load of car seats and it turns over, you might have to destroy the whole load because there's no way to prove that those items were not damaged during that turnover there in the whole load. Also, a lot of protecting of the brands, meaning that they don't want to have it sold at the flea market. A lot of times you go to flea market, you see that the brand name is taken out. Those things are hard and will end up with no salvage. And a lot of time, particularly for the warranties and the protection of the brain, there will be no salvage story. And what will happen in the contract of carriage, in the bill of lading ongoing contract, shipper consent for salvage. If you see the word shipper consent for salvage, you know that nothing can be salvaged unless the shipper agrees to it, and for reasons above, they might not agree to it. So therefore, this partial load, even though things do not look damaged, you cannot sell it. You have to destroy it. This turns a lot of partial damage loads into total loss. Is cargo salvaged or not? If for human consumption, there's no salvage. If items have a warranty, car seats, etc., no salvage. If contract does not allow, no salvage. If no salvage, then debris removal. That's the cost of removing the items. The policies have a debris removal. This is get rid of it. Debris removal will be borne back usually by the record company. You have to pay for it, and the policies have those items in it. If it's salvageable, then you have the cost to protect, unload, and reload. Then move to the consignee that. So these are the things you have to deal with: the crash site, dealing with the record bills, what can be salvaged or not, what we have to pay for or not, both record bills and damaged items, the storage of things like this. These are the moving parts at claim time to talk about with your insureds. Does your form have a duty to defend or an optional? Why is this important? 3 forms. One of them says we have no duty to defend. One item says we have an option to defend. One item says we have a duty to defend. It's not a problem if there's like a load of lumber. We know that's destroyed. It's easy there. It's where you have the things we just talked about before. Can something be salvaged or not? Is it adulterated or not? Is that broken seal on the pharmaceuticals mean the whole load have to be destroyed? Is that Food Modernization Act, meaning because it got rejected, was rejected right? We don't know what the value of items are. That's when it might go to the court system. And if there's no duty to defend, only an option to defend, your insurance carrier might say, look, we're not going to defend that. We will pay once the items and once the amount is determined, but we're not going to defend you. And so this is an important part here. I've had a couple cases where there was defense in court. One was involved in what used cars were worth, and since there was no duty to defend, the insurance carrier didn't defend, and ended up costing the insured about $60,000 in defense costs to sort out what those items were worth. This is things that you need to be aware of. Again, this is where policies differ. Coverage consideration. Bottom line, the insured's customer expect payment from the motor carrier for their property being damaged no matter who caused the crash. Car manufacturer was like for this. So the insurance company considerations for you as a retail agent to sell and for the insured to buy. What's the reputation for paying the claim? Also, will it be accepted by the shipper or the broker? Adjusters dealing with the owner of the property, the insured's customers. They expect everything to be covered, and they want to be paid for the goods that they let the insured haul. Again, the adjusters need to be cognizant of that and how it can interrupt the insured's relationship with their customers, and only reject or not pay when there's obviously things not to. If a problem, the customer is not happy, that's the loss of the future business. And to retain the business of the customer, how cargoes we handle is a big component here. Claim, is it going to be defense or not? Then you want the knowledge of the adjuster handling type of property the insured is hauling. Do they know how to get rid of the steel to be clean? Do they know how to get rid of pickles? In fact, we had an agreement, my father said, where he had an agreement from the insurance carrier cargo that he can dispose of any of these pickles because he knew more about anybody else. What is adjust for knowledge for the specialty industries? There's no right or wrong policy, no better or for worse. The question is, will the policy address the exposures of the insured? So which is the right and best policy? You got to meet the insured's needs. You got to explain the differences and considerations. You got to explain the cost, and the cost is based on what you told us we're hauling. If we're hauling something else, we can adjust what we haul that affect the cost. Every policy would be different. It is the insurer's choice. All coverage forms are and could be different, so you got to read and underwrite the form before you deliver it. We hope this gives you an oversight to providing cargo insurance to your motor carriers. If you have any questions, please send them to and email them to trs@mcief.org, and we'll attempt to answer the questions.